Hi, Chris Maloof with Cross Country Financial here. Big week last week in the markets in regards to interest rates. We're going to do a quick recap today and what we might anticipate seeing here in the near future, so stick around. The Federal Reserve has engineered a massive hawkish shift, causing a bit more stock market volatility recently. But how worried should investors be? We're going to take a quick look back at historical performance for stocks before, after, and much after initial Fed rate hikes to help reassure any nervous investors out there. Also going to take a quick look at the Fed pivot, what that could mean for growth value and large cap, small cap trends given the maturing business cycle. With the recent pivot by Jay Powell and company at the Fed, rate hikes have been getting a lot of attention, and rightly so. Given the bond market has gone from pricing in one 2022 rate hike just a few months ago to now pricing in 3 to 4. That's one of the most dramatic hawkish shifts by the Fed in a short period of time that we've ever seen. So some market jitters are not surprising. A look back at history may help calm some investors' jitters around the start of the Fed rate hikes. Stocks tend to do well leading up to initial Fed rate hikes. Stocks on average a 15% gain during the 12 months ahead of the initial hike of an economic cycle, including gains in all 9 cases back more than 60 years. This makes sense given it's taken a strengthening economy to create job gains and inflation the Fed needs to see to take away the punch bowl. We see the first rate hike coming in either March or May, and with the S&P 500 index up nearly 20% since March of 2021 and more than 10% since May of 2021, those gains may already have occurred. Looking beyond the initial hike, we look back at how stocks performed during various periods after the Fed starts to hike rates. The story is similar, with the S&P 500 up an average of 7.5% first 6 months later and 10.8% over the next 12 months historically. Stocks were up all 8 times 1 year after those initial hikes going back to the early 1980s. So based on history, the start of a rate hiking campaign by the Fed should not be too worrisome for investors looking out longer term. But what does the hike mean further out, say 2023 and beyond? In 2022, we noted that initial Fed rate hikes can help us mark the economy in its cycle. The start of rate hikes typically happens in the early to middle stages of the cycle, where stocks historically see solid gains as we're forecasting for 2022. But we can extend the exercise further and look at how stocks have done from the initial rate hike of a cycle until the end of the accompanying bull market, as we've done in this graph. Those first rate hikes have been followed by an average gain of 67% before the subsequent bull market peak. For those keeping score at home, that would take the S&P 500 to over 7,700 before the next 20% or more decline. No, that's not a forecast. On average, after rate hikes start, bull markets have run for about 3 to 4 years, or 40 or more months, before peaking, with the longest in the late 1990s at 6 years, 72 months, between the 1994 hike and the bull market top in March of 2000. We can also look at where in economic cycles these first rate hikes occurred based on the dates of the economic expansion. This can give us a rough idea of how much more economic growth we can expect after the Fed starts hiking rates. This exercise reveals that on average, expansions were 40% completed upon arrival of the Fed's first hike. However, the August 1983 hike occurred only about 1/4 of the way through that expansion, which we think is more representative of how long this unusual cycle may last. We're not even 2 years in, and we think the cycle has a few more years left. What are the implications for the growth value rotation? After growth stocks performed so well throughout much of the pandemic, value stocks have shown signs of life recently. Year to date, the Russell 1000 Value Index has gained 1%, ahead of more than 5% drop in the 1000 Growth Index. That follows about 4 percentage points of outperformance by value in December. As shown in this graph, the relative strength of value stocks has been closely tied to the yield curve, or the difference between 2-year and 10-year U.S. Treasury yields. A steeper yield curve tends to be good for financials, the biggest value sector, so this makes sense. One of the reasons we squared up our views on the growth and value styles is because we think the opportunity for yield curve steepening may be somewhat limited now that the Fed pivot has occurred and the bond market is pricing in more than 3 rate hikes for 2022. If the 10-year yield doesn't get much higher than 2% this year as we expect, and the Fed follows through with a series of hikes and maintains its credibility as an effective inflation fighter, then the yield curve may actually flatten. Scales may be tilting towards large caps. Small cap stocks have historically done better early in economic expansions. So as the cycle matures, large caps may have an edge. While we do not fear an impending recession, we do believe tighter monetary policy plus the economy's progress towards mid-cycle. As such, we have become a bit less enamored with small caps, taking our view down from positive to neutral this month. While small caps have historically performed well in inflationary environments, this cycle is unique, and we believe larger companies are better positioned for the current environment of supply chain challenges and labor shortages, where a big chunk of the inflation is coming from. In addition, weakness in biotech and other more speculative, richly valued pockets of the market, should it continue, will make it difficult for smaller cap stocks to keep up with their mostly higher quality, better resourced large cap peers. As a conclusion, the Fed has engineered a massive hawkish pivot, contributing to an increase in volatility recently. But a look back at history provides some reassurance, as stocks have historically performed well leading up to and after the first rate hike of a cycle, with significant upside before eventual bull market tops. Bottom line, even with the rate hikes coming soon, we think this economic cycle and bull market have quite a bit of life left in it. If you found this information beneficial, hit the like button, hit the subscribe button. We post a lot of educational content in regards to basic investment concepts. Have a great day.